Hello, it's John Smallwood, certified financial planner, senior wealth advisor at Smallwood Wealth Investment Management. We're continuing on the conversation of the wealth curve blueprint and the scorecard. The goal of the blueprint is to help you get organized, understand all the components of your plan and how they come together and how they're coordinated, and to really understand where your risks are, where your leaks are, where your financial pressure is, where your potential issues are. There's so many things that the blueprint is going to help you do and really get a clear picture of where you are. And the goal is create one today, understand where those pressures are, develop strategies to increase savings, decrease taxes, etc., and put that money to work in your plan. Do that for a year, come back, do it again, do it again, do it again, over and over again. So over the next 25, 30 years, you have really 25 or 30 really solid one-year plan. Super important. So as we look at tax rate and savings rate, we see that, small changes to decreasing taxes and pushing that over to savings and increasing the savings by small numbers are going to really help optimize the future wealth potential. What we want to see in savings rate balance is we don't want all your assets going into one type of vehicle or one tax structure. Like very frequently, we'll find 95% of a client's wealth sitting in their 401k plan. No cash outside, no other outside investments. It's all in IRAs and 401ks. And why the savings rate might have been great, the balance of where the money is doesn't necessarily give the person any balance. And very frequently we'll find those people either with 401k loans or credit card debt because of the lack of liquidity that is in their overall plan. So savings rate balance, if I'm going to save $1, the dollars shouldn't all be in one place. It should be in multiple places. It should be building up your liquid savings. It should be building up your short-term savings, your defensive savings, your long-term savings. And it should be allocated among different types of what we call tax structures. When you think about the tax structure, you have in IRAs and qualified plans, you're making either a pre-tax contribution, the money grows without taxation, and it comes out at a future tax bracket. You could do 401 Roths, where the tax is paid today, the accumulation is tax-free, and then the income can be or could be tax-free on the back end. There are annuities, there's life insurance, there's different tax structures that you want to understand what those tax structures are, what positive effects that they have, what negative effects that they could have, and how do you blend those optimally for your unique plan. As you've heard me say numerous times, your plan is not your neighbor's plan. Your neighbor's plan is not your plan. You are unique. You have different circumstances. You have different family dynamics. You have different goals, different dreams, different fears, different everything, right? So where you save your money is unique to you. How you balance it among different asset classes and different product structures and different types of products is unique to your individual plan. So the balance, and the reason why we start thinking about this, right? If the sole purpose of tax deferral, putting money in a retirement plan, is to take money from a current high bracket and defer it to a low bracket. If I end up in a higher tax bracket, the whole premise of tax deferral was kind of not appropriate, right? So if all my eggs are in that one basket and the bracket goes from the current 37% bracket that we're in back up to the 50% bracket like we saw prior to 1986 tax reform, ask yourself a question. Was that really in my best interest? Maybe I should have paid the tax now and had it in a 401 Roth and have tax-free income later on. That would have been better, regardless of the rate of return, right? Doesn't matter about the rate of return. What matters is what bracket am I taking it out? So balance becomes one of the most important parts of a plan And having that savings rate balance, we think, is so optimal. And it's very hard for a lot of people to really capture, why we're saying it. But when you go along and you experience good times, bad times, sideways times, etc., the way you can react and the way you can take advantage of opportunities is very good if you have balance. If you don't have balance, then it's not going to work well. So in the blueprint, as you create your blueprint and you start putting your assets into the blueprint and where your savings rate is, you're going to see very, very quickly where you're overweight. It's designed to be a visual tool so you can see, hey, all my assets are right here in this particular area. Not that it's bad, but I need to create different balances for different types of out of balance behavior, right? So that, the person that has all their money in real estate needs a higher level of liquidity because of maybe a lost tenant, maybe they need to do massive improvements, maybe they got a DEP issue, all these things. They have a tenant squatting, not paying rent, all the things that could possibly happen. Is the only way to get through that is to have a backstop of liquidity. If you don't have any liquidity and you lose tenants and you have expenses, the probability of losing that property becomes larger. We can go through a series of analysis, but the number one thing is it doesn't matter, about concept. What really matters is where are you? What is this balance? And how do I begin to rectify that balance over time? Nothing is done in a day. It's done over time. So look forward to helping you build a blueprint and build a scorecard. Visit our website, smallwoodassociates.com. Call us at 732-542-1565 and ask to do a blueprint, and we will set you up and get you going. Look forward to it. Thank you. Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.